closed, but the digital asset markets are open. I'm Raghav Chopra. I'm co-founder, managing partner at Tefra Digital. We're a digital asset investment firm, and we also focus on liquid markets, and it's a pleasure to have some great peers here. And so let's kick it off with a quick introduction. So Pranav, David, Ben, Ryan, tell us about your firm and just start with what differentiates your strategy.
Work at a firm called VanEck, large asset manager. I run our liquid strategy. And a punchline, what makes us probably different is we can do both equities as well as tokens. We can go where the opportunity is, and we're a long directional strategy.
My name is David Kalk. I started Reflexive Capital. Initially, this business was run inside of a large macro hedge fund, so the investment team comes from a macro background. I'd say this space, to me, this space is almost never in equilibrium. You have these violently different regimes, this boom-bust cycle in crypto. And so I see a lot of people doing the same thing the whole time despite that fact. And so I think there's an opportunity to adjust the portfolio to one that's consistent with the regime in a way that compounds money differently than strategies historically have.
Ben Forman, a founder of ParaFi Capital. We're a multi-strategy investment firm focused broadly on crypto capital markets. What differentiates us is really our scope. So we invest in both tokens and equity, directional, non-directional strategies, and are early in both late-stage markets. We manage about $1.5 billion, have been around for 7 years, and our team really has a mix of both traditional finance backgrounds as well as kind of deeply technical engineering backgrounds.
Cool. Ryan Watkins, co-founder of Syncrasy Capital, founded in 2022. We're a long bias hedge fund. What differentiates us is we are singularly focused on liquid token investing, and we run very concentrated, and we're very fundamentally driven.
Great. So we're going to launch into some real specifics, but to start, since each of you have some pretty good perspective on how markets have evolved, how has liquid token investing changed over the last 3 to 5 years, and what does it look like for the next 3 years? So at the broadest level, what's different and how's it going to evolve?
Ben, you've been around the longest, so why don't you go first?
We're at like a pretty interesting point in the market cycle. Actually, we kind of say it's the best of times and the worst of times. Right now, like we've seen this, in some ways it's the best of times. Why? Because we've seen this surge of just institutional interest in the space, right? The Bitcoin ETF's most successful ETF launch in history. Tokenization on chain. You have BlackRock that's, tokenizing treasuries, right? You have stablecoin volume at a very meaningful global scale, used in payments. You had Stripe's acquisition of Bridge. There's a lot to be excited about. And I think a lot of that excitement is spilling over into liquid token markets. So in some ways, it's the best of times. In other ways, it's a very tough time to invest in token capital markets. I think fundamentally, there are too many tokens. There are divergent incentives and governance issues that are plaguing the space. There's a big mismatch between supply and demand. The institutional bid is really not coming outside of the top 10 coins. To the previous panel with Eric Peters, he touched on this. And in prior cycles, you look at 2017 bull market, 2021 bull market, there was this idea of this ubiquitous bid across all alts. Alt season was what it was referred to. And, Bitcoin would trade with a beta of 1, and Ethereum would be up 1.5x, and alts would be up anywhere from 2 to 5x. And everything was kind of one big macro bet. But what we're seeing today is just much, much more return dispersion. And as a token investor, I think what it really comes down to is you need to untangle complexity to identify alpha in the market. And not to kind of nerd out for a second, but I think the return dispersion is more leptokurtic. So there's a fat right tail, and then, a fat left tail, and then a bunch of things that won't make money on a forward-looking basis. So it's a tougher market. There's more of a flight to quality, more dispersion. Things like buybacks matter. We can probably talk about that later, but the market and this whole process, I think, is a healthy one, because if you think about digital assets, they've been around for 15 years. The asset class overall has been in price discovery. Like, are these currencies? Are these commodities? Are these capital assets? The market didn't really know how to value them. And now the market's getting smarter. So I think this is a healthy process. And I think we're just going to be in a much more of an alpha-driven market versus a beta-driven one.
Yeah, so I think very good points. If you had a fund 5, 6, or 7 years ago, it almost didn't matter. You just got to be early, and everything did go up, and so it worked out. You could absorb whatever volatility came from the market because everything would just go up 1,000,000% and then down 90%, and that worked out okay. But not the first time in the history of capital markets that there's a certain set of performance that money chases in a way that satiates that performance and then some. And the biggest problem, even for being a liquid token investor at this point, is there's just way too much money chasing very few venture opportunities. And as a result of that, these tokens, when they first come to market, are just priced at a price where nobody wants to touch them. And so no longer can you perform in the same way by just having access and being early in the liquid market. So yeah, I think the next few years, looking for new ways to source edge in this market. I do think we have a set of incumbents who are mostly investors or have succeeded based on their venture capital prowess. I believe very strongly that a venture capital investor and a trader are different skill sets and almost the opposite skill set. And based on the fact that most tokens are being managed by VCs, there's an opportunity for I think traders to come in and source edge and outperform by being risk managers, by being professionals. I think there will be more active management required, more token picking as well, because not everything will go up. But that does support new sources of alpha from here.
We were all hanging out before coming here, and I guess I was like the most bearish person in this panel. So the altcoin market is 560 billion, give or take. It's like take out Bitcoin, Ethereum, and stable coins. That's where you kind of end up. I think that number is going to go a lot lower between now and like the next 18 months. Many of the things you've talked about is probably the reasons why, but generally, the industry is kind of overbuilt, quote unquote, infrastructure by using a lot of buzzwords, and most of that stuff is commoditized. And on the other side of like stablecoin legislation, I think you'll see a whole range of companies adopt, let's just say, stables and the things around stables like tokenized products and all these things. But the winners of that will be the actual companies that adopt it. And it's not necessarily going to be the things under the hood. Because again, the things under the hood, in my opinion, are generally commoditized and probably might not even be used. So most of that market cap is useless and will disappear. So the question then is like, if you have that view, how do you generate alpha in that period of time between now and let's just say the future state, 18 months from now? And to us, much that will come into public equity markets. Generally we were early to find Coinbase and Robinhood as some winners in the last couple of years. Similarly, we're spending a lot of time today looking at internet companies, e-commerce businesses, just digital native businesses that have interchange fees as their big cost line item. And to the extent they can leverage stablecoins in the future, how does that cost structure change? And what does that mean for multiple expansion on these businesses? So if I looked at my portfolio 18 months ago, a lot of that was in tokens. If I look at my portfolio going forward, I think a lot of that will be in public equities. And that's where I think most of the returns will come from.
Yeah, maybe just a couple final points, because I think we definitely talked about this before and don't want to be repetitive. I think we're starting to see a material change in the underlying fundamentals of the projects. So we go back to 2017, and most of the market was driven off ideas. So the ICO boom was all about people releasing white papers, and white papers are really just broad ideas for what this technology could potentially achieve. But it was all vaporware. And you fast forward to 2021, and the expectation heading into that cycle was that this was all vaporware. So all we needed to do to get the ground running again was just to show that this works. And that's what we did. We invented DeFi, NFTs, and all the things that people got excited about in that 2020 to 2021 cycle. But the problem, and I think this is still a problem today, is that so much of that growth is very cyclical. So you look at all of these different financial protocols, whether it be exchanges, lenders, it is very cyclical growth that is dependent on flows coming into the asset class and prices going up. So it creates this scenario where whenever prices are down, the fundamentals actually start to deteriorate. And that is a fundamental structural issue that the asset class has today. But how does this look going forward? Because that was also one of the points we were making in this. And I think we're starting to get to a point, and this will be a transition period, it won't happen overnight, where we will, because we have more regulatory clarity, because we have more institutional participation, because we have enterprises starting to more seriously enter the game and really use these systems. You know, we talk about Stripe acquiring Bridge and starting to make them real push into stablecoins. You talk about BlackRock tokenizing assets on blockchains. Like, these are actual, not just experiments, but people really making bets on this technology reshaping the financial system. Now we can get to a point where fundamentally we're not just betting on cyclical growth, we're betting on compounding growth. And that is a much more compelling story. That is a much more sustainable story. And I think that's how you get to get people to underwrite this asset class on a long-term horizon and not just as this cyclical boom-bust sector where you have to time the markets and get in and get out.
Yeah, great segue. So there's been a lot of cyclicality, but the question is what's structural? And we've talked about the outsized role of macro in the investment process, but on a fundamental basis, in each of your investing activities, have the fundamentals actually led to an idiosyncratic return as far as token dispersion and outcomes? And if it hasn't, then when do you think that'll happen? And are there key metrics, whether it's just a few, whether it's TVL or others that you can pin down that are the true drivers of value accrual? So where do we stand on that?
Maybe I'll start by saying we should replace the word cyclical with speculative, because that's really what it is.
Hyper-cyclical.
Right? Well, like speculative, like people's desire to gamble. Because I think it's most of like when people quote fee metrics and you know, price to earnings on tokens and things like that, it's really like people's underlying driver is really like people speculating on different tokens with leverage. So on the other side of it is like, I think we've been spending a lot of time on our side talking to folks servicing fintechs who are essentially facilitating cross-border B2B transactions using stablecoins. And I think that's a non-speculative source of demand and activity and fees. And ultimately that's going to trickle down to a variety of blockchain projects. It's still not very clear who exactly. We have some views on who this could be, but I think we're still in the early sort of discovery stage of that. And I think ultimately that will get you to the point where fundamentals will drive performance for tokens. But my personal view is we're a little far away from that.
Yeah, I think I would argue that fundamentals do shape the outcomes, but it depends on what sectors of the crypto economy you're looking at. So there are sectors that are more mature and further along in their life cycle. I think DeFi is one of them. And then there's way more speculative early stage sectors like, say, AI. And if you're looking at AI and none of these projects have any meaningful economic impact, then yes, of course, fundamentals don't matter. It's just all about narrative, storytelling, flows, and that's pretty much what drives the returns. And if you're looking at DeFi, I would argue fundamentals do matter. And yes, there is a debate on how much of the growth that these protocols experience, is it driven by speculation? Is it cyclical? Or is it actually something that's more sustainable and compounding? But it does actually shape the outcomes. And I think a good example of this is Solana from 2023 until, basically end of last year, where it did a, public, like a liquid 20x from the bottom and then maybe 10x from where most people could buy. What caused that run, and why was that so outsized compared to all the other smart contract platforms? It's because it got the usage, right? You could actually pull up a chart and see that Solana was earning way more fees than every other blockchain, including Ethereum. And there's a wide variety of metrics you can use to make that call. So I'd argue that fundamentals definitely do matter, but you have to take the fundamentals with a grain of salt, given all of the kind of the flaws that almost like the revenue quality of many of these projects is kind of low.
Yeah, just to add to that, I mean, I think people often pose the question, like, do fundamentals matter? As if it's like a binary question, like a on-off switch on a light switch. But really, it's more of a light switch on a dimmer, right? Like, how much do fundamentals matter? And I think the reality is they're mattering more and more. I think if you look at decentralized finance, I mean, there's a non-trivial amount. We estimate kind of like $2 to $4 billion of on-chain earnings. These are people, users, doing things on-chain, and they're willing to pay protocols, which are effectively these kind of toll booths on the internet, a fee for engaging in either trading, borrowing, lending, or buying insurance on chain, or any sort of these fundamental transactions. That's real GDP that's flowing through blockchains. And I think at the end of the day, like one of the challenges with fundamentals is just there are too many tokens, and it's very difficult for retail who really has been the marginal buyer, to understand which tokens have fundamentals and which ones do not, because it requires like parsing on-chain data, right? There are no 10Ks and 10Qs in this market. There are no gap financials. And so it's very difficult to determine what really fundamentals are. Like, is it users? Is it volume? Is it earnings? And so as the data in the space gets better, and also as protocols that are earning these fees actually like start buying back their own token, I think fundamentals will matter more and more. It's been a long journey, but I do believe that markets over long periods of time bend towards fundamentals. It just has to be the thing that ultimately drives market prices.
Yeah. One of the tricky things, and okay, here's the macro guy coming in to share a macro view, is it like, it feels like it depends on the regime. So, I could see this regime, like the fundamentals, which guided me over the last 12 months. It's like those could totally flip and multiply by -1 for the next 12 months. And I see kind of fundamental analysis struggling with, things tend to work episodically in a way that make it hard to fixate on any set of fundamentals as long-term drivers of performance. And so when we've done analysis, okay, to this, should we look at this like a PE ratio? In a bull market, like, again, do the opposite, because people are trying to 10x their money and not own something that has free cash flow yield or whatever. And so that's, it makes it very difficult to answer that question. And I think going back to the macro just reflects the role that capital inflows. I mean, the space is just never in equilibrium. If capital is flowing into the space, a certain set of things work. If it's not, a certain set of things, or, very few things actually work. So as the core of our process, we like to start with, do we see a feedback loop of price and capital flows and fundamentals reinforcing each other? If we see that, then we'll play the fundamental game. If not, you got to run in the other direction.
Yeah, good. I mean, the complexity is like no other, but that also puts the fun in fundamentals. Over the last couple panels, whether it's regulatory or institutional flows, there's just a slew of forces, and there's been an obvious sea change. The question here is, since we're talking about outperforming, what do you think is underappreciated as a bullish force for the liquid token markets, and what's underappreciated as a potential bearish force in your outlook? So,
Mr. Bear,
based on where we are, what are people missing that frames your view?
So I'll give you the bull case, I guess, since I was bearish for the last couple of times. I think I came into the space because I believed tokenized equities were going to be a thing one day. Just businesses could tokenize this asset that's their equity, and they can do useful things with it beyond just represent kind of this ownership thing. And that's happening. We're tracking that very closely. The general thesis we have there is, if you go on rwa.xyz, you'll see that 150 million people in the world own stablecoins. That number could be exaggerated, give or take. Let's just say that's the number. 5 billion people on the planet have an internet connection, so 150 of 500 is a decent number to start with. But as that number grows and more folks across emerging markets, other places outside the United States, get stablecoins in their wallets, they're going to want to own productive assets with it. And I think that productive asset is going to be tokenized equities. It's great for the issuer. Every issuer is going to have their thing they want to do for their business with a tokenized equity. And it's great for the purchaser because they're getting a productive asset. So to the extent that story plays out faster than I expect, that's your bull case, because that's going to create a very specific winners in DeFi. That's going to create a very specific set of winners on L1s. That's going to create some market structure based on where all that activity takes place. So I guess I don't know if that answers what you were asking.
But why should we be so bearish?
What's that?
Why should we be so bearish?
Because I think it's going to take longer than the next 6 months.
Yeah, that's a long time. To build off of the last thing I was saying, so what is like macro being applied to crypto to mean? Does that mean like you're looking at new home sales and buying Bitcoin? It's more about using a macro toolkit to understand this closed system. And is money coming in and out? Is credit coming in and out? What is the cycle pattern that we're seeing? And I guess the most bullish thing I can say around this current moment in crypto is we've had some episodic inflows into Bitcoin, which has been tremendous. But the rest of the space has not seen an inflow in 2.5 years. And so the question is like, is that going to happen? Because I think if it does, we should be very open-minded to what that will feel like. There's a lot of people sitting here in March of 2025 making terminal conclusions about what this cycle is. There's too many tokens. We're never going to have an alt season like 2021. We don't really know what it's going to feel like if money flows in. And the pattern which I am super fixated on with respect to this process is this self-reinforcing relationship. And Pranav's heard this about 30 times from me, but this concept of market reflexivity is just so important. It explains everything in this market because people are trying to identify network effects, and network effects are often people speculating and chasing price. And so you get this dynamic where price goes up, the fundamentals in the space get much better, and then capital flows. So then price goes even higher, the fundamentals get better, and capital flows. So that's a feedback loop where we haven't had that in motion yet. You can say it's not going to happen, but the underappreciated bullish potential is the fact that that could get set in motion. And then I think all bets are off, and we should be excited about a whole new setup.
I've heard the reflexivity pitch.
Yeah, I've heard it many times.
But I'll give you a different feedback loop, which is we start with money needs to flow in for the thing to kick off, right? So then I ask you, why is money going to flow into the stuff? Because the thing I notice is like until we see real use cases where people outside this room are touching and feeling products that are leveraging some things on chain, I have a hard time seeing a lot of money flowing in, especially enough to offset all the vesting and all the stuff that's happening outside. As I talk to folks outside the crypto world from just purely from this asset manager perspective, the thing I notice is like the most common question is like, I see all these positive regulatory headlines, but like, I don't touch and feel this stuff. Why am I supposed to care? Right? Where's my chat GPT? And I think it will happen. I think it's going to be tokenized equities. It's just a question of timing. I would never want to comment on my actual fundraising process, but I know there are allocators out there and I hear what they're saying. And I think the most important thing is they're still engaged in this asset class. And, I think basically there's just all the kindling is there for any catalyst, which yes, it's impossible to see exactly what it is. And maybe it'll take 6 months for a chase to build. And I do think this regulatory catalyst, was significant enough to activate people in new ways. They just were not going to come in December. They were not going to come in January. These dog groups, as Eric Peter mentioned, these are 6 to 9 month timelines. They have calendars to them. They're having their first quarter committees and they figure out their managers over the summer. And then maybe in the fall they're ready. So yeah, I think if you force me to tell you the catalyst of what it's going to be, I would say I don't have one and maybe that's not going to happen. But I think this stuff can build in a way that it's very hard to see now, but we shouldn't sell it short.
For Ben and Ryan, so on this, right? On this unlock question, underappreciated bullish or bearish forces, but also is stablecoin legislation and market structure legislation a real unlock for the liquid token markets, or will it come and go?
Okay, so there's a lot to unpack. So I think like we talked about cyclical, but I think secular like demand for block space is really like ultimately the North Star. And if our industry created nothing more than stablecoins, that would be an enormous TAM. Like the market for moving dollars on the internet, on blockchains, is absolutely staggering. And actually, if you think about stablecoins today, they're a $200 billion market, but 70 to 80% of every transaction on a blockchain involves movement of a stablecoin. So if people ask you, what are people using blockchains for today? It's really moving dollars. And I think what you'll see in the coming years, and this is agnostic to wherever token prices are, this is a secular trend. What you'll see is stablecoin supply will go from 200 billion to 2 trillion in the next 12 to 24 months. You'll see sending and receiving wallets of stablecoins go from 25 million monthly active senders and receivers today. I think that number will also grow meaningfully. And both of those numbers, like senders and receivers and stablecoin volume, have both compounded at 40 to 60% growth rate over the past 5 years, agnostic of a bull or a bear market. And I think the issue that allocators have is they group crypto with AI. Fundamentally, I believe blockchains are more of a B2B technology. I don't believe that consumers will interact directly with blockchains. I think that's the wrong framework. There's no chat GPT of crypto. I'm sure plenty of people disagree with me. I believe that the 90,000 financial institutions in the world, the banks, the fintech companies, will be the consumers of blockchains and will use them to move money. And I don't think that requires like anything else getting built in this industry for it to be very, very valuable. So that's my take on that. And then look, I think that with stablecoins growing, DeFi is going to grow too. Because it's only natural if you're moving dollars on a blockchain, you're going to want to do things with those dollars. And I think the biggest underrated force today or going forward will be token buybacks. The value of the stock market is the net present value of all the earnings of the companies that are listed. I think the net present, the value of altcoin markets are the net present value of all the on-chain earnings that they generate, primarily derived from these stablecoin earnings. That number is growing. I think right now it's trading at a very low multiple relative to growth. And you have the supply and demand dynamic. So again, like I think buybacks will be the prevailing force. But yeah, I think everything we need is actually been built today, and anything extra is like optionality in terms of like new use cases and AI. Like I think people get excited about that, but stable coins, real world assets, Bitcoin, just those three things are absolutely huge.
Yeah, so I'll share a couple more points on the productive assets points, and then maybe I'll give a bearish take on this as well. I think on the productive asset points, what do blockchains do at their core? They enable you to create assets, to move them around, and then to enforce contracts between them. And this isn't meant to be reductive because, contracts are the basis of many institutions. There's almost like a theory of institutions that they're a nexus of contracts. So I think it's just a core building block that you can use to build many different things. Well, what happens when you put this power into the hands of not only institutions, but into the hands of individuals? Well, in some cases, you get really great things like stablecoins. People put dollars on blockchains, and all of a sudden you can move it around the world super cheaply, and it's fast, and it's efficient, and everyone in the world can access it. But what people also do when you can create an asset on a blockchain for 1 cent, and then you can have anyone who will trade it, is they create dog coins and cat coins and all these ridiculous things, right? And that is what has happened. And you look at even like Solana, which was like the leading blockchain by usage over the past year. The top exchange on Solana, it was like Radium, about 70% of the volumes were meme coins at the peak. I mean, this is what people were doing here. So what is the issue? The issue is not that these assets exist. It's just that there aren't higher quality assets that have been uploaded to blockchain so far. So when we talk about this regulatory unlock, this is the ability to take, you look at like in Solana right now, there's maybe around like tens of billions of dollars of assets that are on Solana. Ethereum, maybe like higher, maybe like higher tens of billions, maybe around $100 billion of assets that are uploaded on Ethereum. When you talk about uploading the rest of the financial system onto blockchain rails, you're talking about like tens of trillions of dollars that are going to be uploaded onto blockchains. And you're no longer going to have people that are just buying and creating and selling a bunch of nonsense. It's now someone is funding an entrepreneur in an emerging market to go build a startup, right? It's now people are financing a government to go and, fund some program. I mean, this is how you actually unlock the productive crypto economy. And I think that the regulatory constraint being lifted is actually like a huge underappreciated unlock and actually getting increased utility of the blockchain. So it's not just like this very circular economy where everyone here is just questioning, what is this used for? And then on the bearish side, because I do think that I own a bunch of this as well, we talk about like almost a common theme among all the bull cases is that we have this regulatory unlock and then therefore we can go and do all these cool things with blockchains. Well, one of the issues that I've seen recently is that it seems like the industry is starting to become more politicized. And the risk that you have when you have an industry a technology that's starting to be politicized is that, well, administrations change. Like governments change. If we get a change in Congress, if we get a change in the administration in the next 2 to 4 years, and the technology is still a political lightning rod, then a lot of this can get unwound. And we'll be back at square one where we're fighting against another really challenging SEC. So that's a risk I do think about in the back of my head.
Good. Well, we have a ton of other topics, but it's lightning round time. So whatever the safe harbors will allow, since you're immersed in the space and we want to give real money value to our audience.
Not financial advice is what you mean, right?
Never heard of that. But we're going to do a packaged last question. So the question really is, what do you think crypto market cap in trillions ends the year? What do you think Bitcoin dominance is? And your best sector theme?
I'll let Ryan go first.
Yeah, so I think we end the year probably around like the same more or less market cap. I think this will be a flat year. And then as far as, was it sector theme?
Sector theme and Bitcoin dominance.
And Bitcoin dominance. I think Bitcoin dominance also ends the year around the same. And I know it's kind of a boring answer. And then as far as the sector theme, I think is most exciting, it's DeFi. And basically for the reasons we just discussed, which I won't repeat.
So I would say 3.5 trillion, so maybe 20% growth from where we are today. Bitcoin dominance, I think, grows this year. So we're at roughly 58-60% on Bitcoin dominance at the moment. So I think that maybe grows modestly to say 60-62%. And then I'm going to also, not to be trite, but I'll go with DeFi as well.
Okay, I'll go 70% probability of 4 trillion market cap, 50% Bitcoin dominance. So that's Bitcoin basically right here and an altcoin cycle materializing. And 30% chance of 1 trillion.
Oof.
That's pretty good convexity though.
So the EV ends up where you are, kind of.
Yeah, but not in altcoins.
So in that
In Bitcoin. Okay. Bitcoin, the skew is bad. The altcoin skew is good.
So if you include stablecoins, or do you not include stablecoins in dominance?
I think we've been including stable.
We've been
including.
The big issue with dominance is Ethereum.
Right. So I would say
dominance
Bitcoin dominance is lower marginally because of stables. I think crypto market cap is, well, most likely lower, but unless like Scott Besson figures out how to buy more Bitcoin, being budget neutral. So that's a kind of like call option on Bitcoin. So if that happens, I think all bets are off in some ways. And the sector that's most interesting is, again, like public companies that have nothing to do with crypto that can leverage stables.
Great roundup. Thank you guys. And thanks Blockworks. Really great discussion and good debate. Thank you all.